Hello viewers, in this video we'll be going over natural gas. In this video we'll be going over the day-by-day probability model, how we find the models, and the forecast models for natural gas. So back to the technical analysis. Today we are up 1.11%, and on the 1 hour chart we're on positive MACD, and if we were to expand out to the 4 hour chart, we are approaching to positive MACD as well. We are using the 9 and 18 moving average as support as we climb up higher. If we extend out to the daily chart, we still see we are nowhere near a convergence on the MACD. We are still near oversold RSI. I do see a possible resistance acting with the 18-day moving average, or I should say 9-day moving average, this blue line. And we also have a price gap down around that range as well. So that is around the price of $2. And as for support, last week we made a multi-year low around the price of $1.83. And if we were to move up higher, that price movement is roughly around 4.3% to the upside, and to the downside it is around 4%. So back to the day-by-day probability model, what we have here as the day progresses, we have a slight favor to the downside. From 0 to negative 10%, we have a 41% chance of it happening. On the extreme case, from negative 10% to negative 21%, we have a 29% chance. On the other hand, to the upside, we have a 0 to 10% chance higher, or 0 to 10% with a 29% chance. So back to the forecast model for natural gas. Again, this model is now available in the link below, so do check it out. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to July 26, 2010 to October 19, 2010. So let me point out why these two charts are similar. So what we have in the current trend, we start off touching the upper Bollinger Band. Next we proceeded to head down lower, averaging below the middle Bollinger Band. At this instance, we see a slight reversion to the mean, touching the middle Bollinger Band right near the end, and then finally we continue to head down lower to touch the bottom Bollinger Band once more. So we have those points there. So in the trend in question, we start off up the upper Bollinger Band, and then next we proceeded to average below the middle Bollinger Band. Afterwards we see it revert back to the mean in the middle Bollinger Band, and next we see it drift lower, touching the bottom Bollinger Band once more. So we have those points there. What we have is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe if the trends and patterns are the same, the outcome and forecast should be fairly the same. So the model that we just examined was July 26 to October 19, 2010. Back then, natural gas was up around 31 basis points. So not much to the upside and not much to the downside. We most likely encountered sideways price action. And if we head back to the day-by-day probability model, that coincides with these ranges in between, and we would most likely not see an extreme case to either the upside or to the downside for natural gas. So again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.